Good morning, everybody. This is Patrick MontesDeOca with the Equity Management Academy live trading room here. And we are live streaming from TikToker. We got a lot of action this morning in the market with gold here. We had another session of short selling here from the average price that we saw here today of 26.56 approximately. And we came down right into the, I want to move this over here so it's not in the way here in any way. It came down right into the buy one level of 26.13, and we're getting a lot of volatility in the silver market. In the paper market, there's a big difference in the price of the futures markets or paper markets or ETFs against what appears to be a potential shortage developing in the cash market. So we have an anomaly between the cash market and the futures markets right now. And I'm looking at the board here, and pretty much the whole board is in red right now. And we've been trading now in silver at this bottom here, looking to test this lower level of support that we have. And what I want to point out to you that what basically the algorithm is identifying for us here is that the market, even though there is this overwhelming bearish sentiment in the paper market, it's come down to an area where it identifies it to be an area of accumulation of supply. When I talk about the structure of the reversion to the mean principle that we trade, which is essentially identifying the extreme levels above the mean of the supply and demand, and the extreme levels below the mean of that supply and demand. And we identify an average price daily, weekly, monthly, yearly, cyclically, in order for us to gauge the equilibrium of that supply and demand. Now, the supply and demand has already factored in the sentiment of the market. And so when the price reaches this pivot points, these levels here, it's telling us something. It's telling us something. And so what the algorithm does is it interprets that energy into a mathematical probability model, that when the price is trading in this blue area that is called accumulation of supply, it's telling you potentially that the market is going to find more buyers than sellers, and this is where you're going to get a lot of the strong hands come into the market. And when we take a look at what happened here on March the 2nd, the market came down to a low of 25.82 and reverted right back up. It put in a reversal, a key reversal day signal by testing the previous low and pretty much confirming the VCPMI that it told you that the 2613 is an area where It is identifying the buy one level and all the way down to 25.39 on the daily numbers. Now, we've been working with the weekly numbers since we came into this week. And so the weekly buy one level this week was 25.75. And the low is 25.82. Not quite coming down there, but sufficing within a 10% margin of error, the completion of the previous pattern. And the reversion that occurred, it validated pretty much the reversal of the market is taking place. Now, what we see in today is a test of this level, obviously. The price coming down here yesterday found more buyers than sellers. And the equation of the supply and demand shifted to more buyers than the selling supply that came in, and therefore it reflected in the price reverting back up. And what I'm trying to identify for you is that I don't need to listen to the fundamentals, to the chatter, to CNBC, to the gurus out there that are forecasting gold. I'm showing you how I'm trading it. Regardless of all of these fundamentals that really, when you really think about it, they don't really make sense. And sometimes the markets will do what the markets want to do, regardless of those fundamentals. Point in case, we have pretty much all over the internet the short squeeze category highlighted, and it's pretty much all over the internet. The Reddit crowd, the Wall Street bets crowd, have created a new element to consider as a player in these markets. And all of that, okay, all of that to me as a trader is reflected in the end result, which is the price. So if we see the price coming up to 30.35 as it did here on the news of this Reddit on February the 1st of the short supply, what the market did is it discounted that news and reverted to its equilibrium price that you see here we've been trading around. And everybody or anybody that bought up here obviously got slaughtered. So one advice that I can give you is do not follow the herd. Do not follow the majority. When you hear that, or you listen to the internet, and the internet is telling you, you got all these gurus pontificating the price of gold and all this shortage and this and that. They're not trading it, they're pontificating it. There's a difference, because trading it means following what the market is doing. And right now, the market in the futures markets, the paper market, is contrary to what the cash market is saying the market should be doing. The market never does what one thinks it should do. And this is the psychology of trading here that deserves more than just one session to discuss, because what we're talking about is emotional risk or emotional management. You know, we manage risk. People talk about managing the risk, but what about managing your emotions, which is a major component of your decision-making process in managing the risk? And sometimes our own emotions personally can get in the way of looking at the market objectively, what it's telling you, particularly if it's going against you. And you're wondering, when everybody is, saying that we have a short squeeze, that the market should be exploding, the market is down 68 cents in silver. So this is a very good example for me to be able to identify and show traders, young traders in particular, that the markets are contrarian in nature, by nature. They do not go when everybody wants it to go. Actually, the markets do not like company. They go when nobody's there. Like, for example, all this Reddit people or people that are buying in the silver market on the basis of all this news of this short squeeze that bought silver in the 30s or all the way up here have given up. They've given up. They lost money. They've given up. It doesn't work. And it's somebody else's fault. As a trader, I'll tell you this. The market wiped out on this correction anybody that should not be trading in the silver market. Because the real traders that are trading this market for what it is, when we can implement the fundamentals, it's never been so bullish. The prospects of gold and silver have never been so bullish. And so understanding those dynamics, I want to use this correction to continue to accumulate my core position, my long-term core position. Especially coming down and cleaning out all the weak buyers in the market, the nervous Nellies, and take a look at the value where we are. And based on the VCPMI, we're looking at the market coming down, and you're looking at the daily chart here, the market coming down into the blue zone. And this is silver. The buy one level is 26.13, and right underneath there we have the weekly of 25.75. The weekly buy one level. Right underneath is the daily buy two, 25.39, and then we have the bottom of the buy two weekly, which is at 24.79. But we are entering into this area that essentially starts to gauge the market mathematically with a probability factor of 90 to 95% that we're going to find buyers down here. And knowing that, obviously, it gives me a strong sense of confidence to allow for the market to validate that, to confirm it, to activate the trigger point, to activate the signal, and for me to act upon it based upon my own profile, depending upon how I want to manage that risk. And once the signal is identified, then obviously you can manage that risk in the instruments that you feel comfortable with, whether it be the futures markets as stocks or ETFs or ETNs. The sector of metals offer tremendous opportunity for traders, particularly the gold mining shares that follow the direction of the gold market. But they're a different class asset than the futures markets. The futures markets obviously are the most volatile. I use it for day trading. I want to take a risk. I go into a futures contract, and if I want to day trade, that is the best instrument for you to do that. And depending upon, again, your profile, obviously you can hold on to a position overnight, or it will make a difference in terms of, again, what you do with that position based on your profile. It's really important. For those traders that are one-lot traders that, I would say, be careful, because the volatility of this market is expanding more. And, we're seeing drops of $30, $40, $50 in gold, like it was $3 or $4 move. In silver, $1.70 is becoming pretty much common. So you want to measure that very carefully for you in terms of taking the risk in the futures contract. So coming back to the market here, we, what I'm waiting for is for the market, to validate or negate the signals that we're looking at. And that is basically that either it's going to come down to 1694 or revert back up above 1715. But we are in an area that the algorithm tells you don't want to sell in here. The chances are by one, basically, if we take a look at the average price, the average price is a 50-50 standard deviation. And so the prices can fluctuate, and they can pretty much go either way. The VCPMI structure is a Fibonacci sequence of 5 levels that identify the extremes levels mathematically of the extremes of the levels above the mean, cell 1, cell 2, or the extremes below that mean by 1 and by 2. It does not use more than that perfect Fibonacci sequence of 5 levels. And within those 5 levels, it ignites basically the AI by giving it the color. It's telling you the highest probability area where it is, and it's in blue. When you're looking at green, it's average. And when you're looking at in red, it's pretty much the area of distribution of supply. So the idea for you guys, self-directed traders, to trade this is basically to look for the market to validate the extreme below the mean and the extreme above the mean, because what happens is the reversion to the mean principle will bring the market to its equilibrium. If it gets up too much above it, particularly above 95%, which is the sell 2 level, it's either going to break this pattern, and the resistance of cell 2 will become the support for the next higher fractal in price, if that occurs. But the AI, the algorithm, tells you that by the time you get to cell 2, whether it be daily, weekly, monthly, or yearly, or cyclically, the chances are mathematically that the market will revert. So when it tells you the price is trading at 1715, you're looking at a 50-90% standard deviation relative to the implied volatility to the mean, with a 1-to-1 factor. And so it's a high probability mathematically. In other words, if you sell here, you only got about a 10% chance and as a trader, I want to go in with the highest probabilities to execute a trade in anything that I do. So knowing this, obviously, I don't want to take those odds. Although anybody, you can, as a trader, can sell anytime in any bar at any time. We have a very specific criteria or intelligence that we are teaching our subscribers in our private trading room, and methodology, and that what the market identifies when it comes down to the blue area is basically an area that you want to start looking at, potentially, again, buyers coming back into the market. So we wait, we see the market trade back and forth. And the trigger is the close above 1715, which is the buy one pivot level for today. The market obviously has identified the 1700 handle in gold to be a very significant level. And in fact, it's matching the Fibonacci trend lines here, the trend line support line, and also the Bollinger Band. A lot of other indicators that I look at and respect are validating basically what the VCPMI is identifying here. So I have a clear picture in terms of what what the market is doing, and then the synergy or reaction to these levels here will activate the trigger point for me to act upon, and then decide what instrument to execute. Continue to hold here in gold. Obviously, if we kick in 1715, then we're going to be activating once again a buy trigger. The silver market is a little differently here in that we're activating actually a buy trigger by trading above 2613. This is the trigger points. Close of up in about 5 minutes at 7:30. A close of up 2613 will activate a silver long or buy trigger. So we have gold and silver trading within that vicinity or that area of accumulation of supply that you see. And pretty much the conservative signal is for gold to close above 1715. The E-mini S&P has reverted from the sale one level, as you see here, of 3893, and it's come down now into the extreme level below the mean. So let's see what the market does down here, as it is indicating now that it's at the extreme below the mean, and it's basically from here, unless the market breaks down, and it continues to the weekly, numbers below, it could potentially revert from here. We're getting some nice green bars here in gold, 1711. Let's just continue to monitor the energy of the market here, as it is validating, what the AI pretty much tells you behind the algorithm, that when the price comes down into that buy one, buy two level, it should identify buyers coming into the market. Strong hands. If you are a multiple trader, meaning multiple position trader, you can use these levels of buy one and buy two to enter and scale into your position, depending upon, again, your profile. If you want to take an aggressive risk, expecting the market either to go up above the buy one or buy two, you can use either level to add to your position. You can buy some here at the market, wait for the confirmation above or below to add more, and depending upon that confirmation, then you can execute, other instruments, other derivatives, stocks, shares that follow the direction of the gold market. One of the arguments that I hear in the market, on the street, so to speak, is that the rise that we have seen on the 10-year bond recently. So I want to just kind of take a look at at interest rates and what the actual charts look like and see what's going on there. But you're looking at a 10-year bond yield chart for Australia, the United States, Canada, United Kingdom, Italy, Spain, Japan, Switzerland, and Germany. And what we see here is that Switzerland and Germany are in negative interest rates on the 10-year bond, below 0.25%. The highest yield is in Australia, about 1.75%. That's the strongest interest rate being paid right now on the 10-year bond yield. So there's a lot of money going to Australia, for sure, based on this yield, into Australian bonds. And what you see here is the tremendous disparity between Australia and Germany, down 0.25%. There's a 2% difference. And I think this is what's showing you the disparity that we have on a global basis of basically the tremendous wealth gap that this is creating. The United States got up to almost 147.70 here just a few days ago, and it caused the stock market sell-off. It precipitated for gold and silver to pretty much come down to these levels that we are in at 1700. The silver market at 26 handle, which is unheard of, to be honest with you. And particularly, just to make my case, when you take a look at the tremendous amount of debt that we're dealing with, which is getting close to $30 trillion, any rise in interest rates is going to affect the balance sheet, the payments of this tremendous debt. And it puts the government, the Treasury, under tremendous pressure if, in fact, this is a continuing path that we're looking at interest rates. It has created, an alarm, for sure, to the bond market. And so, are we moving into higher interest rates? Well, if you analyze the tremendous amount of money that's being implemented into the market, what the market is saying pretty much is that, yes, it's going to be inflationary, and that's why interest rates are beginning to rise, are beginning to anticipate the possibility that all of this stimulus that's coming into the market is going to increase price inflation. What we have seen here, obviously, if you take a look at some of these assets in stocks and Bitcoin and all that, what we have seen, collectibles, what we have seen is asset inflation. And I think we're moving into the next phase, which is pretty much price inflation, excuse me. And so when you obviously take a look and compare, the CPI, the commodity index, it's indicating, energies are, $100 off the lows from last year. I mean, you got soybeans trading at $14, copper at $14.14. We're beginning to see a commodity bull market unfolding as a consequence of this prospective monetary policy moving forward. The market is going to need more stimulus than what they are offering right now. What they are offering right now is just to cover past, emergency, so to speak, just to a Band-Aid to the reality that once all settles down and we know pretty much what the damage is or has been done, so to speak, because of this pandemic, we're going to get a better handle in terms of the damage that was done. And so the fear that the market seems to be running into right now is that if interest rates rise, the gold market should collapse. And it's kind of a contradictory argument because the reason why interest rates are going up is because it is anticipating that we're going to see a high level of inflation developing in price assets as a consequence of what we have seen as the supply chain being broken. And as we move back into the economy, as we move back into some kind of normality, as we're beginning to see, the velocity of money could exceed the supply available and ignite and accelerate price inflation. I don't know about you, but I'm having a hard time getting supplies, essential supplies, that are life-threatening supplies to some people. And what I'm beginning to see is truly that there is a shortage of just about everything developing. From some of the essential resources, gold, silvers, some of the essential chemicals and medicine, like iodine. So the next cycle, I believe, that we're going to be facing with is, the effect of a stronger than expected economy igniting the pressure to raise interest rates. And so that puts a tremendous pressure on the Feds, because their policy based upon this huge amount of debt and stimulus that needs to increase is going to be very expensive unless they take control of the yield curve. Unless they take yield curve control. And essentially what that means is that they will be capping the 30-year bond yield, putting a limit on it so that interest rates cannot go up on the 30-year bond, which is really where most of that debt is located. If interest rates rise, just think about it, on a $30 trillion, if they go back to, some kind of normal 2-3%, you're looking at tremendous pressure on the budget, on the economy. And so the reality is that no matter what the talk is out there, they are going to maintain interest rates at low levels, ideally as close to negative rates like Switzerland and Germany as possible, and finance our way through this humongous record debt that we have, and come out on the other side through this pandemic. So, point in case, I'm referring to the kind of a market and the kind of environment that we had back in the 70s, where interest rates, they exploded to 14% by 1981, right after Nixon lifted the U.S. gold standard of the U.S. dollar and went into the U.S. petrodollar as the world's reserve currency, obviously. And what we saw was that was the beginning of what we're looking at now, in that the U.S. dollar has collapsed against gold more than 98%, I believe, and it's on the way to zero, basically. And the debt has exploded to record levels. So we have the difference is that obviously now we have these two factors that are so predominantly important in terms of monetary policies moving forward from here. And the reality that I see is that rates cannot go up. They're not going to raise interest rates. They'll talk about it. The market may push on it and demand it, but they, if it comes to push and shove, so to speak, what they'll do is they will control the yield curve and allow for inflation to run to where it wants to go. And to a certain degree, in allowing that to happen, may be the salvation for for the Feds in that sense, because what the economy needs is a certain level of inflation, a certain level of recalibrating ourselves into this new economy, into this new world that is beginning to indicate we are running, and we could be running at a potential shortage of supplies as we come into the rest of this year. A little more pressure here coming into obviously more silver. The silver market is more volatile than the gold market, obviously, and the volatility factor is far greater. And so we're looking at stabbing again into this area of support. So let's continue to watch the market for a little bit and see what it brings to us here. Obviously, one of the results that we get from this short-term run-up in interest rates is that it's supportive for the U.S. dollar for the time being, short-term. So the dollar took a bid, and it came up to 91.01, up 23 points, and that's pretty much what is going on right now, that the gold market is taking a look at interest rates at the 10-year yield, and they seem to be pretty closely correlated in that if the yield, if interest rates go up, the dollar goes up, it's strong for the dollar, it's bullish for the dollar, and it interprets to be bearish for precious metals as an interest-bearing instrument. And this is the misconception here that I believe people are making the mistake of, although short-term, it might be the way to go into the dollar, but I think long-term, we're looking at a serious deterioration. But yet they're hitting the metals again. And so you want to trade this with a maximum dollar stop that's comfortable for you. And as I said, depending upon your profile, if we do get a break into this lower band, it becomes even a higher probability to buy the market. The question is, again, your profile. So what I suggest is on any of the trades, use a max dollar stop, wait, let the market do its thing. If it comes down below, it activates the level below, you buy into it. Or if it goes back above, you buy into it at that point. But you have a range in which by you can monitor monitor your dollar stop in that sense without getting stopped out, without allowing the volatility to wipe you out, because we can be back at break even at your entry point here in no time. And just be prepared. We are entering fast market conditions, and reversions from these levels are highly likely to unfold. And we want to pay attention to that. So if you were a conservative trader, you could wait either for the market to close above 1715 or to come down to 1893. And aggressive traders, as I said, could have bought the market anywhere in here and still be looking to add to your position on a close below or close above these levels. We're back up above 26 on silver, 2602. More buying coming in. Fast market in gold, 370. This is what I mean by expecting a reversion to unfold from these levels. This is what the AI tells you. So don't go short here. Look to buy into this area if given the opportunity, all the way down to that B2 level. So the indicator, the VCPMI, again, is like a GPS for your trading, for your driving, as you're trading, and it allows you tremendous flexibility for you to customize this intelligence according to how you manage risk, how you manage for your personal profile. Good buying coming in here. And that's what we want to see. That's what the AI identifies here. This is what's supposed to happen. We want to see buyers come back into the market enough to overtake all the supply that's being given and activate trigger points. So the supply that we're looking at may be coming in from central bankers, from institutional selling that have an interest, you might say, in keeping the prices of silver and gold down as much as they can for, personal reasons, obviously. And also for, either economic or political reasons as well, because depending upon who's doing it, it just simply is part of the same team, so to speak, that is not allowing the markets in gold and silver to essentially have free price discovery. And you get this pump and dumps of, supplies that are 10 times the actual annual delivery. And you get this flash drops here, the sell-offs, especially in the silver market, because it's a very thin market. But what you're looking at is the short selling pressure that brought this market down here is losing control, because what you see here is that buyers step up here. And when you get buyers stepping up here, taking this supply in, more than what they're selling, you're going to get the price reflected right away, and you're going to get these green bars. And this is where you start the momentum unfolding until the price reaches and closes above the pivot point 1715, and boom, the buy trigger is activated. Automatically, the target of 1726 is in place. And I keep, recommending to my traders in my trading room and here for you self-directed traders here to pretty much be able to have access to this intelligence. We provide this intelligence literally 23 hours a day in our trading room. And I prepare my trader subscribers basically with this information and coach and teach the application of the VCPMI. We go back about 2613 and silver. We're going to be activating again a buy trigger. About 2611 actually. I'm sorry, 2613 in that vicinity. Fast market on metals to the upside. Prepare for fast market conditions. $26.13 silver traded, activated a signal 26.13. We're getting some good bidding on gold and silver here, reverting back down from this this new low that we made here. So what you have seen here, ladies and gentlemen, is the resolution of the variable changing price momentum indicator, artificial intelligence, essentially, which is written in C++, easy language in TradeStation. And I'm sharing with you as a courtesy to you as a self-directed trader looking for opportunities in these markets here that essentially could change your life. Truly, truly. This environment that we're dealing with, particularly in gold and silver, is a historic event that is yet to unfold. And what we're looking at is just the beginning of this tremendous explosive market unfolding in the commodity markets, and pretty much in precious metals here. As you can see, the intelligence is tremendously accurate. It's a question of how you apply this information based on your profile. My personal opinion is that we are within maybe weeks, if not days, from potentially what could be the biggest rally in precious metals. And I would say to you that this rally will particularly begin when the sentiment is at its most bearish. That's just the way it is, with the variable changing price momentum indicator as a contrarian indicator to the sentiment. Once again, ladies and gentlemen, I want to thank you for the opportunity to share this with you, and I hope that I gave you some insight, in a little deeper insight in potentially how you want to use this incredible tool. Continue to stay long, buy corrections, do not panic, manage your leverage intelligently, and you'll see what happens here in a few months. Take care. I'll talk to you soon.
The risk of loss in trading commodity interests can be substantial. You should therefore carefully consider whether such trading is suitable for you in light of your financial condition, and considering whether to trade or to authorize someone else to trade for you. Past performance is not necessarily indicative of future results.